With rates increasing, everyone wants to snag the best rate possible. But how do you do this, and especially as a first-time home buyer? I'm unmatched at getting my borrowers the best rate possible. So in this video, I'm gonna share with you exactly how mortgage rates work, secrets lenders don't want you to know, and how you can snag the best rate possible. Hi honeybees, welcome back to my channel, or if you're new, my name is Ciara and I do videos on finance and lifestyle. I'm a full-time mortgage loan officer and I have helped hundreds of people to buy homes and build wealth, so I take everything I know and I share it with you in hopes that you will build wealth also. If you find this content helpful, be sure to join my Patreon where I'm offering more exclusive and bonus content on lifestyle and finance topics you already love, along with digital downloads, giveaways, live Q&A and coaching sessions, Discord access, patron shoutouts, and more. So whether you're a homebuyer honeybee and want more one-on-one help, a business owner or loan officer wanting knowledge for success, or you just want to get to know me in a more personal way, you won't want to miss all the great content I have. So go to www.patreon.com/Elaine to join. And the link will be in the description. Okay, so what are mortgage rates and how are they determined? Your interest rate determines the amount of interest you pay on your home loan over time. The lower your interest rate, the less interest you pay over time. But mortgage rates, however, they're not as simple as, just giving everyone the same mortgage rate. Mortgage rates are dependent upon the stock and the bond market, and they fluctuate daily and even throughout the day. So they are ever changing. Also, your individual rate is very specific to factors in your individual home loan transaction, such as your credit score, loan type, loan amount, DTI, and more. How do you ensure that you are getting the best rate possible, especially in a changing market where rates are increasing and fluctuating? So the first factor that is going to affect your interest rate is your credit score. In fact, your credit score and your loan to value ratio are probably one of the two most important factors in determining your interest rate. So if you don't take anything else away from this video, I want you to get this part. The most important factor in determining your interest rate and the best way to ensure that you get the best interest rate is to increase your credit score. Maximizing your credit score, making sure your credit score is as high as possible, is going to give you the best chance at snagging the best rate. And not only that, having the highest credit score possible is not only good for helping you get the lowest rate possible, but also for getting the best loan options and pricing possible. The higher your credit score, the lower your rate and the lower your monthly payment. Even just a small boost in your credit score can actually make a huge difference. So take a look at the recent data from FICO, for example. If you had a score of 659 and you were able to bump it up to 680, you could shave more than 0.6% off your interest rate, which is actually more than 0.5%, which can make a significant difference in your monthly payment as well as how much interest you pay over time. So even bumping your score up, say 20 points, 15, 20, 25 points can have a huge difference on how much interest you pay over time. Now, I've done multiple videos and I have an entire credit playlist on my channel that I will link above and below, but here are some fast and quick tips to improve your credit score. Number one, pull your credit report and alert the bureaus of any errors. Become an authorized user on someone's account who has a long and good standing payment history so that you too can benefit from that score increase. And with an authorized user, that is something that will instantly boost your score. 3, ask for a credit line increase for the accounts that you already have. That will bump up your credit score without you having to do anything. Now make sure that when you do get an increase or limit increase that you're not using the amount that you get the increase for. This will help decrease your utilization, which will increase your credit score. Now, if you don't have much credit at all or no credit, which is keeping your score down, consider getting a secured credit card or a secured loan, or doing some kind of credit builder loan. This is a great way to get your credit started and to provide a boost without you already having a credit foundation. Lastly, if you are somebody who needs a little bit more guidance or professional help, I recommend going to see a mortgage lender or seeing a reputable credit repair specialist that specializes in improving credit for the purpose of buying a mortgage. And if you have access to neither of those, I definitely encourage you to check out scoremaster.com. I will leave a link below. This is kind of a one-stop shop for helping to improve your credit. On average, people that use ScoreMaster have a credit score increase of 61 points in just the first 20 days. A lot of my viewers have already signed up and have seen dramatic score increases already. I'm so excited. You can enroll in 1 minute and it doesn't affect your credit score, and you can check it as much as you want because it's a soft pull. Then you use the ScoreMaster Move Me slider to see how many points you can get. And I love this. You can also see how many points you can lose by spending. ScoreMaster, it'll save your plan so that you can leave and you can come back. Now your plan will detail precisely what accounts to pay, including how much and when. That's big. And you can even share your results and your strategy with your lender so that you guys can better discuss your options and better deals. ScoreMaster will also show you which cards to use and how much to spend. Then what's cool is it allows you to see precisely when you should pay your cards back so that it doesn't hurt your score. So you have the Score Builder feature. Score Builder actually creates a personalized plan to help you understand what's helping and what's hurting your score, plus what actions you can take. Use the action buttons to ask questions or solve problems on your credit report or online banking transactions. With a simple button, you can remove identity theft, negotiate debts, resolve reporting problems, and ask questions directly with your creditors. Now, Score Boost helps you see how your payments can help increase your credit score. It shows you how much to pay and by when. So when you're using this, you'll know the optimal time to apply for a credit card, auto loan, mortgage, or other credit. So your plan includes post-payment by date targeted so that you pay it before your creditor reports your accounting details to the credit bureaus. You also get alerts. Now these alerts, they help prevent credit card fraud even before your credit card company does. You'll receive alerts for suspicious activity, payments due, and credit monitoring events. And you can link your phone so that you get the alerts even faster. You also get a money manager, and this is where you can manage all your finances from one simple dashboard. You can do all your online banking in one place, and you can use the action buttons to quickly ask questions and resolve problems. You also get $1 million of identity fraud insurance for your entire family, everyone in your household. And to get this level of coverage from, say, like LifeLock, you would be paying upwards of $30 a month. So this is actually less expensive and you get more. And included in your subscription is getting your 3B report and score. So you will get all three bureaus, Experian, TransUnion, and Equifax. And it's an easy way for you to see your credit report. You can switch the way you view it. And you can view it this way and see all your history, or you could view it the other way, which is like this. And then you can jump to different sections. You can see your account history, your revolving, installment, public records. It's really simple to use, and it takes you down to the area of the things that you're trying to look for. And you're able to make sure the information matches all three bureaus, and you want to make sure that all three match. And if they don't match, that's when you want to make sure that you take care of it. And that's something having the 3 bureau report every month will do, because you can monitor your report every month to make sure that all 3 bureaus match and there's no new accounts you didn't open or theft, so you can protect that new great credit score that you worked so hard for. And last but not least, you get the Privacy Master feature, which really helps to protect your personal information. It's going to just keep monitoring for compliance. Now this is really good because some sites may take 45 days to respond, while others may remove you right away. For some, you may have to request they get removed again. So you really want to have this every 14-day scanning going on so that you can remain aware of what's going on with your credit. Scoremaster.com replicates what I do with my clients who are in need of home loan approval and need a credit boost. And to me, it's totally worth it. It may be somewhat of a quick fix if you don't have access or money for a credit repair specialist, or you don't have access to a mortgage lender. I just think it's a great program. It's already helped so many of you, and I'm so excited to recommend it. So like I said, it will link down below. If you're in need of a credit boost and you don't know where to start and you don't have a lot of money, I definitely recommend it. Okay, so the next factor is your loan type. Rates do actually vary with loan type. Not only with loan type, but also loan term. If you're looking to maximize your interest rate or to get the lowest rate possible, you'll want to opt to go for a government loan versus a conforming loan or a conventional loan. Government loans tend to have the lowest rates. So that means FHA, USDA, VA, as opposed to a conventional loan type. Also, you'll want to consider the term. Longer loan terms have higher rates and shorter loan terms have lower rates. If you're wanting to get the absolute best rate possible, you might consider a 15-year term as opposed to a 30-year term. Or you might look into getting a 15-year ARM, which is an adjustable rate mortgage, as opposed to a 30-year fixed. Anything that is 15 years is going to be lower in rate than something that is a term of 30 years. Also, anything that is adjustable versus fixed is going to have a lower rate as well. So adjustable is always going to have a lower rate than a fixed mortgage loan. Do keep in mind though, with a shorter term, you are going to be paying more monthly, but your rate will be lower and you will also be paying less interest over time because you are paying the loan off in a shorter amount of time. So if you do have the extra cash flow monthly to handle a shorter term, then the savings that you will get is going to be very worth it. If you are wanting to keep your monthly payment as low as possible, a shorter term may not be the most advantageous. So keep this in mind. Also, when you're looking at a fixed rate loan versus an adjustable rate loan, the adjustable rate will give you a lower interest rate. However, your rate is subject to change after a certain amount of time. It could end up being lower at first, but it could go higher in the future. So if you are going to go with a 15-year or an adjustable rate mortgage as opposed to a 30-year or a fixed rate mortgage, understand the risk that you take by getting an adjustable rate, knowing that that could change and get higher over time. So you would either need to refinance before it increases, or you need to go with a fixed rate mortgage. Also understand that that shorter term does mean a higher monthly payment. So keep that in mind when you are making this decision. But for the purposes of explaining this, you would be getting the best possible rate if you went with a government loan and you went with an adjustable rate mortgage on a 15-year term. Now that is not, again, like I said, for everyone, but if you wanted to go to the extreme, then you would opt for those loan factors to get the best rate possible. A government loan, like I said, is going to have a lower rate, tends to have a lower rate overall. However, if you have a higher credit score, conventional is still usually most economical. That is because with a conventional loan, it's designed for mortgage borrowers that have credit scores of around 720 or higher. It decreases the amount you pay in monthly mortgage insurance, which in turn decreases the amount of your monthly payment. So therefore, having a higher rate with a conventional loan may not always end up meaning more per month because you also have a lower monthly mortgage insurance. Before you just gung-ho decide on going with a government loan to take advantage of the lower rate, make sure you ask your lender to do a loan comparison of what the numbers look like for a government loan versus a conforming loan. There you can pay attention not only to the rate, but how your monthly payment is affected, as well as what your closing costs and your pricing overall, like how that differs. You want to pay attention to more than just rate when you are looking at buying a home. So make sure that you're not so focused on trying to get the lowest rate possible that you make a decision that is not overall economical for your situation. Okay, so the third factor, or the third thing you can do to optimize your interest rate, is what we call a buy down. If you have a little extra cash, you can pay what are called discount points. These discount points qualify you for a lower rate. This is also what we call an interest rate buy down, or what you would refer to as buying down your rate. I always ask my borrowers what their ultimate goal is. Do you want to have the lowest possible monthly payment or the lowest possible cash to close? If someone tells me they want the lowest possible monthly payment, that means we need to get their interest rate as low as possible. So if that person wants the lowest monthly payment, but say you have some extra cash you can use, you can pay for a lower rate. For example, your standard market rate that you get assigned based on your credit score, loan type, all of that, let's say it's a 4%. This is the rate at which you're not paying anything to lower it, but you're also not going up in rate and receiving credit towards closing costs. This is just your standard rate that you get. So let's say it's 4%, but you really want a 3.5%. You can have a 3.5% if you opt to pay more in closing costs to bring that rate down. So for example, let's say the cost of lowering the rate from a 4% to a 3.5%, let's say that it's $1,500. If you were originally paying closing costs at $4,000 for a rate of 4%, then you would add $1,500 to your whatever your closing costs are. So instead of paying $4,000 in closing costs, you're gonna pay $5,500 in closing costs. Don't think too deep into it. Just know that in order to lower your rate, there's gonna be a specified amount you have to pay extra in closing costs. Now, when you're talking to your lender, what you will have to do is have them to calculate at what amount will it be worth it for you to pay down the interest rate but reap the maximum benefits. This is a good reason of why it's important to have a really good mortgage loan officer. They're going to help navigate you through what is going to work best for your individual goals and what your home loan is. So the third tip that I have, the third hack, is to buy down your interest rate. This is another reason why I tell people to save as much as possible when buying a home, because you never know when you may need to buy down that rate a little to hit your target rate that you want to get. Conversely, you can actually go up in rate from whatever your standard rate is, and you can get credit towards closing or get money towards closing, which we call lender credit. So say you have 4% and you have a little wiggle room in your monthly payment to go up to a 4.5%. That may give you, say, $1,500 in credit. So instead of paying $1,500, then that means you get $1,500. So the higher your rate, the more you get in lender credit. The lower your rate, the more you pay in closing costs. Get it? Okay. Now, if you're thinking of doing this, just make sure you consider your long-term plans first. You want to make sure that you're going to be in the home long enough to reach the break-even point, meaning you want to make sure that you're even going to be in the home long enough to reap the benefits of buying down that rate, or else it might not be worth it. One question I always ask my clients is, how long do you think you're going to be in this house? Is it a starter home? Are you going to be looking to upgrade in about 5 years? Or is this your forever home? Will you be in it forever and probably never leave? These are all factors that play into whether it's worth it to buy your rate down or not. Most people don't pay a mortgage for 30 years. They either move and sell or end up refinancing before that 30 years is over. So make sure you're very realistic about your goals and about how long you're going to be in this house before you make decisions about buying down your rate or spending extra money on a buy down. Your break-even point is the point at which your savings from buying down the interest rate outweigh the cost of the points. You just want to make sure that you're getting your money's worth and that lowering the interest rate is actually going to be beneficial to you in the long run. Okay, and the last factor is down payment. Another great way to get a better rate is to increase your down payment. Though most of the time you can get away with a lower payment or whatever the minimum payment is required for that loan type, you typically get the best rate when you put 20% down. This is only one of the reasons why people often preach putting 20% down. If you're getting a conventional loan, not only does it save you from paying monthly mortgage insurance, which lowers your monthly payment, it also helps you to get the best rate. So if you don't have 20% to put down and you can only put the minimum, that is completely fine. But just know, if you're one of those people who is super picky about rate and you're trying to get the absolute best rate as possible, consider putting more down and consult your lender to find out if this indeed will help you to get the best rate and have the best outcome. Now, why is this? So your down payment directly affects your loan to value ratio. When you put more down, you have to borrow less. So that gives you a lower loan to value ratio. The lower your loan to value ratio, or your LTV, the lower your interest rate can possibly be. So the more you put down, the lower your interest rate is likely to be. When it comes to getting the best interest rate possible, you want to present to the lender as the lowest risk possible. And in order to have the lowest risk possible, that means you are borrowing less. A lender sees this as risky when you're having to borrow more. So the less you have to borrow, the less risk you pose to the lender, and the lowest interest rate you will likely get. Having said that, when it comes to getting the best rate possible, don't drain your savings trying to put a higher down payment or trying to do a buy down. Keep in mind that you will be responsible as well for your closing costs, which are typically 2 to 5% of the loan amount. So you'll want to make sure that when you're applying, you have as much saved as possible, because not only do you want to show that you have enough for the minimum required down payment, but also to cover your closing costs. And lenders like to see that you have somewhat of a cushion. So they like to see that you have money saved above and beyond what is required for the home loan transaction. This makes you less risk as a borrower, and this will help you to have better chances of getting approved. So using these hacks and shortcuts to getting the best rate possible may only work out in your favor if you have the extra money to put down or the extra money to buy down. Don't drain your savings trying to get the lowest rate possible, because it may be counteractive to what you're trying to do. Now, lastly, I wanted to give you a few other tips that will be useful when trying to get the best interest rate possible. Another way to get the lowest interest rate possible is to make sure you minimize your debts. The amount of debt you have is going to determine your debt to income ratio. I've covered this in a variety of other videos, so if this is a new concept to you, definitely check out my guide to home buying, where I will walk you through all of this terminology, and a lot of this may make more sense. But essentially, your income that you get every month, as well as your debts that go out every month that are on your credit, are combined to a ratio to get your debt to income ratio, or your DTI. Your DTI is very, very crucial in determining your approval status, as well as how much you get approved for. The lower your DTI, the better interest rate you're going to have, the better approval chances you're going to have, and the higher approval amount you're more likely to get. So in order to reduce your DTI, that means you have to reduce your debts. So minimizing your debts and keeping them as low as possible, those monthly payments as low as possible, is going to lower your DTI and help to give you the best interest rate possible. Another tip that will help you to maximize your interest rate is to consider adding a co-borrower. Adding a co-borrower helps the lender see your loan application and your status as a borrower as less risk. Why? Because there's two people on a loan, or two people responsible for the mortgage versus one. If something goes wrong, it's more likely that the other person can come in and pick up the slack, versus if something goes wrong with just you, you're more likely to default on the loan. So lenders like seeing that you have a co-borrower on your mortgage loan. So not only will this increase your approval odds, but it could help you get the best interest rate possible because it is considered an application strengthener and makes you less of a risk to the lender. And the last thing you can do is opt for a shorter rate lock. Now, what's a rate lock? Earlier, I mentioned that rates fluctuate with the stock and the bond market, and they fluctuate very freely and very often. Rates fluctuate often, they fluctuate throughout the day. So how do we keep your rate fluctuating while we're in the loan process? We do this by locking the rate in. Once you get a purchase agreement, we do what's called a rate lock. Once you've gotten your rate or you've chosen your rate, we lock that rate in place so that it does not change over the course of your loan underwriting process, so that you can keep the same rate throughout underwriting all the way up to close and it never changes. There's different time periods that you can lock a rate. There's a 15-day lock, a 30-day lock, a 60-day lock, and a 90-day lock. Usually a lender is going to lock the rate in for the amount of time that they think it will take to close the loan. In general, most loans take about 30 days or less to close. So typically you're going to get a 30-day lock. In some cases, it may take longer, so you may opt to get a 45-day lock or a 60-day lock. Sometimes you only need to lock for a 15-day lock. Let's say you opt to not lock your rate in and to do what we call floating the lock, meaning you don't lock your rate in, you kind of just let the market do its thing and you decide to lock later on. Let's say it takes 30 days to get your loan done and you decide to do a 15-day lock. That would mean you don't lock the rate until 15 days out from closing. When you decide to lock 15 days out at closing, you're going to be at the mercy of the market. So if the market changes for better between when you get a purchase agreement and when you decide to lock, then that means you would have a better interest rate than if you did a 30-day lock. If the market worsens during this time period before you lock, then know that you're gonna have a less optimal interest rate than if you would have decided to lock earlier. How do you decipher this? Wouldn't everyone just get the longest rate lock possible? No, the reason is because let's say your lock expires. So let's say you do a 15-day lock and you end up taking 45 days, or you do a 30-day lock and you end up taking 45 days. Your lock is going to run out at the end of your rate lock term. Once your rate lock expires, you have to do what's called an extension or extending the lock. Every time you extend the lock, it costs you money. For that reason, you don't want to lock until you are pretty sure of how long it's going to take for the process to go, and you want to make sure that you are locking in at a time period when you feel like the market is most optimal for you. So something that you can do to ensure that you get the lowest rate possible is to do a shorter lock term. So that means maybe waiting until you're 15 days out from closing and doing a 15-day lock. Keep in mind, the shorter lock term means the shorter amount of time that your rate is locked in without you having to pay more. So just make sure that you and your lender are accurately gauging how long of a lock period you will need. If all of this is confusing, then all you need to know is that a lower lock term means a better rate. The longer your lock term, the higher your pricing and the higher your rate may be. So make sure when you do talk to your lender, you talk to them about your rate lock term and how that affects your pricing and your rate. Okay, honeybees, I hope that was helpful for you. If you learned something in this video today, make sure to give me a big thumbs up. Don't forget to subscribe so you can be a part of the Honeybee fam. Hit the bell button so you get notified of when I upload. I respond to all comments in the first 24 hours of going live, so having that bell button is vital if you want to leave a comment that you want me to respond to, or you have a burning question that you want answered. Also, don't forget to check out scoremaster.com. It's a really, really useful tool. I think could benefit so many people, and I have already seen so many people get score increases. It's so worth it. I will leave it down below. It's scoremaster.com. Also, don't forget to check out my home buying guide, my credit guide. I have lots of previous videos where I break a lot of these concepts down even more. So definitely make sure to comment below if you have questions questions and check out the other videos. Thank you guys so much for watching. I love you to the bank and back, and I'll see you in my next video.